Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. Today, we are going to take a closer look into the quarter three results of DMart, whose parent company is Avenue Supermarket. Now, DMart is at a critical juncture. It is facing dual challenges. Firstly, how to maintain its supremacy in the brick and mortar business, in the sense the physical store business, and how second one, a second challenge, how to face competition from the rapidly growing quick commerce businesses. It has these two challenges in front of it. Now, the quarter three results have been a mixed bag. Revenue and profit both have risen, but how the company strategizes to face these challenges, what does the financial health of the company look like? What are its valuations? What do analysts say at this juncture? Let us take a deep dive and look into these details in this video. So, let's start. The quarter three results of DMart were a mixed bag. Its standalone revenue increased by 17.5% year on year basis to 15,565 crores, while its standalone profit increased by 6.5%, standing at 785 crores. But today's market fall has impacted this stock as well. Now it has the market fall has reflected broader economic concerns and sector specific challenges. The stock closed at 3,500 levels today, but seeing the current volatility, broker recommendations have become more cautious. Motilal Oswal maintains a buy rating but lowered the target price at 4450. Morgan Stanley has an underweight rating targeting 3720 levels. Goldman Sachs has a sell rating on the stock with a target price of 3425. City also has a sell rating with a target price of 3,500. So, brokers are cautious when it comes to DMart. Now, let us look at the fundamental factors of the company. The first factor to check is the financial performance, the financial health of the company. Well, for quarter three, the revenue has increased by 17.5%. I've already told you that. The company has also reported a healthy CAGR in its sales at 25.5% for the last 9 years. As far as profitability is concerned, net profit has risen by 6.5%, and the company has maintained a consistent profitability with a 5-year CAGR of 23%. Gross margins have risen by 25 basis points year on year basis. However, EBITDA margins have declined 40 basis points to 7.60 due to weaker store productivity and higher cost of retailing. So, that is an area of concern. The next factor to check is store productivity and expansion. Well, the company added 6 stores in the second quarter of financial year 2025, bringing its total store count to 377 stores. Now, it plans to accelerate store addition in the second half of this fiscal year. The same store sales growth, where in the sense stores which are older than 2 years, moderated to 7.5% in the first half of 2025, with a sharp decline of 5.5% in the second quarter of financial year 2025. Well, revenue per square feet remained flat at 36,000. What does this indicate? It indicates potential challenges in improving stores productivity. How does the balance sheet of the company look? What is its debt position? Well, the company is almost debt free. A thumbs up for the company. Now, its debt to equity ratio stands at 0.0317 in its latest fiscal year, which is very negligible. Cash flows, the operating cash flows of the company have been strong, growing from 2678 crores to 2743 crores in the current fiscal. So the balance sheet of the company is quite healthy. What does the valuation for the stock looks like? Well, it is on a higher side. The PE ratio, price to earning ratios, currently stands at 96.5, which is significantly higher than the industry average. The PB ratio, price to book ratio, stands at 12.18, also indicating that the stock is trading at a substantial premium to its book value. The enterprise value to EBITDA, that multiple stands at 69.25, which is also relatively high, suggesting that market has higher growth expectations from the company. So the stock valuation is on a higher side. Next, let us check the competitive position and e-commerce strategy implemented by DMart. Well, DMart has a strong competitive position when it comes to value retail segment. What is the reason? The reason being its focus on everyday low prices and efficient operations. Making everyday products available at discounted rates is a strong selling point at DMart stores. How is it facing the e-commerce competition? Well, DMart plans to expand the DMart Ready online grocery service, which has grown by nearly 21.5% in the first 9 months of this financial year. So it has shown impressive growth. The top management at DMart has also seen some rejig recently. Its longtime CEO Neville Naronna, who was at the helm for nearly 2 decades, has quit. His shoes are going to be filled by Anshul Asawa, who has been an executive with Unilever. Coming to technical analysis data, DMart shows short-term support levels at 3592, 3527, and 3462 levels. Now, it has already breached the 3592 level. In the medium term, the support level stands at 3669, and in the long term, it shows a support level of 3400. Now, given the volatility and that it has breached the 50-day moving average of 3744, there are chances that you might see some more correction in the stock as per analysts. So, caution is what major analysts are suggesting when it comes to investing in DMart. So, to conclude, even though markets are choppy and volatile, and analysts have advised caution, DMart long term prospects are solid. Why? Because the company is literally debt free, its operating cash flows are healthy, and what is going to change is how people shop. Correct? The business that DMart is in, day to day items of use, is never going to be out of business. But how people shop, instead of going to physical shops, people now prefer the digital means. So how DMart transitions from the brick and mortar style of business to quick commerce is what is going to lead to its future success, and how they strategize and plan that out will decide where the stock will go. From an all-time high of nearly 5,900 levels, the stock today is at 3,500. But as I told you, long-term prospects look good. Again, given the current market situations, it is very necessary that we listen to experts and people who are in the know for many, many years. And as advised, caution is the best way forward. Keep looking for what happens to DMart, and then decide whether it is investable. But at current levels, if you ask me, the stock is still trading on high valuations. So wait and watch can be a good strategy when it comes to Avenue Supermarket. If you have any other view, or if you have questions related to this video, please feel free to comment below the video, and a happy discussion can help you as well as me in our investing journey. To conclude, I want to quote a few lines by Mr. Ramdev Agarwal of Motilal Oswal. Now, in one of his interviews, he had said that he had a positive outlook about retail sector. Why? Because it is not specific to a particular class of people, but it caters to all and sundry. So the market size is humongous. He's like, to quote him specifically, he said that there are 7,000 prospective buyers when it comes to retail, and Avenue Supermarket is one of the leading players in the retail space in India. correct? The way they do business might change given rapid digitization in this sector. Like their success depends on how quickly they are able to adapt, correct? So watching out what they do is very very important. uh, Please like, share and subscribe to my channel if you have liked this video, and keep looking for the next video where we analyze one more interesting stock. Until next time, stay safe. Goodbye.